Welcome to the daily insights that matter. Now, Reliance Industries will be demerging Jio Financial Services soon, and this has led to a frenzy amongst investors as it would have potentially led to outflows from the Nifty given that the NSE used to remove the stock from the index's components as per the old process. However, in an important development, the National Stock Exchange has decided that a demerged company will be retained in the Nifty index, reversing the earlier practice of excluding it. For example, if any index constituent was merging or spinning off a particular division of its business into a separate, completely new entity, then NSE used to remove it on the date of the shareholders' approval. However, this would have led to substantial outflows from that index constituent, especially in the case of a company as big as Reliance, which constitutes about 10% of the overall Nifty. Now, in the new methodology, the stock will be retained in the index. Additionally, the spun-off entity shall be included at a constant price, which is the difference between the demerged company's closing price as on T-1 day and the price derived during the special pre-open session on the ex-merger date. Now, the special pre-open session is conducted for the purpose of price discovery of stocks in cases involving corporate restructuring. Eventually, the spun-off entity will be removed from the index after end of day on the third day of its listing. Now, this change is expected to reduce the number of index constituents being shuffled around due to demergers, which is positive news for businesses looking to split up their options. Now, in fact, that it will apply to all companies involved in demergers approved by shareholders on or after April 30. Now, the change has come ahead of the shareholder approval for the demerger of Reliance Industries Limited and Jio Financial Services, which is scheduled for the 2nd of May. So, it couldn't have come at a better time as it will allow Reliance Industries with the highest weightage amongst the Nifty 50 companies to stay in the index after their upcoming demerger with Jio Financial Services, and this move is in line with global practices and was made in response to feedback from the market participants. The Securities and Exchange Board of India is the regulatory body responsible for regulating the security markets in India. Now, in a move to protect the interest of investors, SEBI announced that it has barred 3 individuals from participating in the securities market for a period of 3 years and imposed penalties of around 5.8 crores for spreading manipulative information via Telegram. Let's discuss this. Now, SEBI has barred 3 entities which involved 6 individuals from the capital markets for running a pump and dump scheme. What is a pump and dump scheme, you may ask? Now, this scheme involves recommending a stock to drive up the share price and then selling shares at inflated prices to generate profits. Now, in the investigation, SEBI noted that the administrators of the Telegram channels had bought stocks for their own personal and family members' accounts before recommending it to the other investors as a buy recommendation without declaring their own stakes. Now, the administrators would then dump their holdings at inflated prices after luring thousands of investors into the stock, making enormous illegal profits. Now, SEBI's sole motive is to manage and regulate the securities market while also protecting the interest of the investors. Earlier as well, SEBI had banned 45 entities, including actor Arshad Warsi, for participating in the securities market for making YouTube videos to manipulate share prices. SEBI has issued a flurry of guidelines in the recent months to regulate finfluencers and stop the instances of celebrities using fame to manipulate the stocks. Now, we would advise you to do your own research before purchasing a stock and look at a long-term wealth creation strategy or seek professional advice with us while making big decisions. So, what does all of this news mean for you? The change in methodology is a positive for Reliance Industries, which will be demerging Jio Financial Services soon, and other index constituents looking to split up their businesses. Had the methodology not changed, it could have led to outflows from the stocks and the overall Nifty. This will therefore have an indirect positive impact on you. Now, the ban and penalties are a positive move towards regulating the market. However, we would encourage investors to do their own analysis and not resort to tips and advisory services on social media platforms which are not regulated. Additionally, the perspective should be of long-term wealth creation and financial independence, as 21 din mein paisa double doesn't ever work in the process of sustainable wealth creation. This will therefore have an indirect positive impact on you. With this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.